Hello there. Welcome to the Open on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Canada has recorded its first trade surplus since the beginning of the year, driven by a rebound in exports. Data from StatsCan shows the nation recorded a surplus of $153 million in September, after a deficit of more than $6 billion in August. Total exports saw an increase led by a spike in metal and mineral products. And meanwhile, the trade surplus with the U.S. widened to almost $9 billion, marking the largest since February. Dollarama reported a 22% spike in revenue in its latest quarter, beating expectations. Discount retailer also reported higher profit and same-store sales that exceeded estimates. The company is increasing its 2026 outlook for Canadian same-store sales. And Empire is out with its latest results, and the Canadian grocer posted revenue in its latest quarter that topped consensus. There was growth in same-store sales. Profit, however, came in below expectations. The owner of Sobeys, Farm Boy and Freshco, says the decline was due to higher expenses, including higher staffing costs, store upgrades, and spending on growth. U.S. futures set for a marginally weak open. The market not happy with the heavy spending going on at Oracle on AI equipment, and that stock slid in the pre-market. The TSX closed at a record high yesterday. One of the stocks lifting it was Shopify on optimism about its use of AI. Let's check out how oil is trading right now. Oh my goodness, falling towards $57 US a barrel. We keep hearing the G word, glut. That's the big fear among the oil bulls for next year. And let's have a look at gold. Gold holding in there today as well, up about 0.5%. And finally, let's have a quick look at the Canadian dollar to see how it's faring. And the Canadian dollar holding in, as you might expect, with our central bank avoiding another interest rate cut. We saw shares in Oracle sliding more than 10% in the pre-market. The company missed estimates on cloud computing sales. You can see the shares now down about 13%. And it also reported a jump in spending on AI data centers. The problem for many investors is that this heavy spending on AI is taking longer than they want to translate into actual cloud revenue. Let's get more from Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth Management. Great to see you. Thank you very much indeed for joining us. Oracle, in a way, has turned into the poster child, hasn't it, for when it comes to concerns over AI. They have more than $100 billion in debt.
They do, Andrew. I think the concern with Oracle, obviously they missed earnings. Their software revenue was also light, but they keep adding more CapEx spending. And at some point, you're going to look as an investor and say, when am I going to get a return on this money? When's Oracle going to get a return on this money? Mm-hmm. And I think it's a question that investors are going to have. There's other parts of the AI market in the ecosystem that are probably easier to look at getting returns on. Oracle's a name that we don't own. This is probably one of the reasons. A lot of that number of them getting return on the investment might be years and years away, and I think it's going to be less than people expect.
I mean, Larry Ellison's been around a long time. He's in his 80s. He's not slowing down. I wonder, the market seems to be wondering, has he got it wrong this time?
Yeah, I think I don't know if Oracle's got it wrong. You don't want to bet against Larry Ellison. I think the question is, how long is it going to be before you get there? That's really what this issue is. I think a lot of the investors expect to get returns on this big CapEx spending right away. The only people that are getting returns right away are the people selling chips. But a lot of these other companies, a lot of the hyperscalers, it's going to be a while.
What is your feeling broadly on the market? The central bank, the Fed, divided on whether more interest rate cuts are needed. Are you paying a lot of attention to monetary policy these days?
I try to avoid monetary policy as much as I can, Andrew, to be honest. I think at the end of the day, stocks trade based on earnings. And the earnings have been very good. Most people on Wall Street have underestimated the earning capacity of the S&P 500. The last couple of quarters, and that's part of the reason we've had rallies. A lot of people have been short. Areas of the market like the Russell 2000, they've been very short. And I think that's really what drives things. Yeah, monetary policy, if rates are going to come down, that's certainly probably going to help small caps even more than it has in the past. But I think at the end of the day, earnings drive stock prices. And I think that's really what we focus on is where labor is, where inflation is. They're kind of important, but at the end of the day, how a company operates and if they're making money or not is ultimately going to drive the stock prices. That's what we try to kind of navigate around the noise that's out there is look at, are you making money? And if you are you growing your earnings? And that's what we want to invest in.
Yeah, we kind of forget our earnings and dividends are they're the reason to own a stock.
Yeah, absolutely. I think what happens is during these lulls where there's not a lot of earnings, what happens is you start to get more into that noise. I mean, earnings, we'll talk about Oracle today. It'll be a big discussion point. But a lot of the earnings for the last 2 or 3 quarters have been very strong. And if you look at where Wall Street has been, they've been very underweight that earnings momentum. And I think that's why you're seeing some good rallies. It's an underowned, underloved rally in the U.S.
You have some stock ideas for us, names you like. NextEra Energy, a big electricity seller, and huge in Florida, which is a fast-growing state.
Yeah, I mean, you know that this time of the year, we see a lot of Canadian license plates all over Florida. So we know everybody comes down. They enjoy the warm weather. In the U.S., it's the #1 grower in terms of people migrating there. So you've got new customers, which obviously as a utility is very good. And rates going down is good. They're also a clean energy play. I mean, a lot of times they're in the solar business. They do wind. They do a little bit. They've got nuclear. They've got a lot of these other things just besides the demographic story. And I'm looking for stocks that are lower beta. And what happens is everybody in the portfolios has a lot of these high risk, AI type stories. I'm trying to find some things that are not the regular stuff that everybody else owns. And NextEra, to me, represents a good demographic story.
Your shop based in Punta Gorda, Florida, I believe. But you haven't noticed fewer Canadians knocking around after Mr. Trump's comments on us becoming a state, etc.?
Yeah, maybe a few, but I tell you what, I was driving to work this morning. There was a couple Canadians. I had some Ontario plates in front of me, so they're there. The thing about what happens with the U.S. with policy is you still have the weather in Canada, and it still gets quite chilly, and people, maybe there might be some more. They're not going to go to Arizona over Florida because it wasn't comments the Florida governor made. It was the U.S. president. So I think a couple people may have said, "Hey, I'm not going down this year," but after the first cold snap, I think people realized, I'm going to go down and enjoy the warm weather.
Investors in Toronto have been buying into our senior housing stocks, and you have an idea in that. You say it plays into the aging of America theme.
Yeah, it's a company called Ensign. It's a small cap name. We do own this theme across multiple asset levels. We have a large cap theme. So this is our small cap. It's called Ensign. Same idea. Everybody is getting older and they want to be in a facility that's not feels like a facility. It's a retirement center that's got stuff going on. It's skilled. It's a place that you'd be okay with having your mom or dad go to. And I think that's the scenario that they play well into. We're having more and more people live longer in every country, and this is a trend I don't think that's going to go away. Again, like NextEra, it's a demographic change. People move to warmer weather. As people age, and they're aging longer and longer with people living the 90s and 100, you're going to need somebody to be able to take care of those people. They can't stay in their house forever. And these are not what I look at when I look at my grandmothers or great-grandmothers' nursing homes. These are nice places to go with activities. And they're growing revenue. I think their 8-year record of earnings is 13% a year compounded. It's a strong business. I think you can invest in multiple different companies in this space with different asset sizes.
Michael, thank you very much for joining us.
My pleasure, Andrew. Good to see you.
Michael Landsberg, Chief Investment Officer at Landsberg Bennett Private Wealth Management. Coming up, the Canada Revenue Agency has a new plan to improve customer service. That's ahead. Back in September, the finance minister set a 100-day timeline for the Canada Revenue Agency to fix call centre delays. Its improvement plan has arrived. Let's get more from Scott Hurst of CTV News. So we've reached the finance minister's deadline. What can you tell us, please?
Good morning, Andrew. Many of the upgrades have been focused on helping Canadians get the service and information they need from the CRA without having to wait on the phone line and ultimately plugging up call centers, meaning much more time just waiting for an answer, as the CRA claims. And the government claims it is making meaningful progress after this 100-day review. Of course, the government does not launch a 100-day review unless it really needs to fix something. And Canadians are getting increasingly fed up with the service being provided by the federal agency, notably wait times and the time it needed just to get an answer. And in October, the Auditor General also released a report showing in part call centers were sorely lacking in terms of providing accurate information. And so this 100-day review was launched by the Finance Minister, François-Philippe Champagne, and these are some of the results that we're hearing from the government, claiming that the number of unique calls answered has more than doubled from 35% to 70%, and this came through the extension of some contracts, as well as the rehiring of more than 1,200 employees to help reduce wait times. And according to the government, close to 60,000 Canadians have used a new scheduled callback program for issues related to things like account access. Now, of course, tackling problems with the Canada Revenue Agency in the fall is one thing, but tax season, as you might expect, is an entirely different beast where call volumes will surge. Last year, the CRA received more than 32 million calls throughout the year, peaking during tax season at about 300,000 a day during filing season. So, of course, that is when Canadians will have the chance to decide themselves if these improvements are actually working and can be sustainable.
And CRA, like so many other organizations, says it's using technology to make customer service better, including AI.
Leaning into AI and much more automation to help reduce the wait times. And as I mentioned, to ensure that people don't have to make a phone call just to get something answered or to get service from the CRA. So the government says it is making progress in making it a more user-friendly experience. For example, some specifics that they tell us: if you lose or forget your CRA sign-in details, which often can plug up phone calls, you can now get back in online rather than getting stuck on the phone. This change, it claims, will help divert some 300,000 calls a year. The agency also claims that its generative AI chatbot is getting better, much better at answering more complex questions. Once again, meaning you can get your answer through interactions online versus having to wait on call, wait on hold, of course, trying to get your answers. And customers, it claims, have used the chatbot some 240% more than this time last year. So you package all these changes together, which is why the government claims it is making some progress. But of course, much more progress needs to be made to improve this experience overall.
Thanks very much, Scott. Scott Hurst, our colleague at CTV News. Up next, Capital Power, the electricity seller, just signed a deal to supply an Alberta data centre. We heard from the CEO. That's after the break. Capital Power has penned an agreement on U.S. natural gas, generation, I should say, with a data center developer in Alberta. And south of the border, it's working with private equity player Apollo Global Management to seek acquisitions of natural gas assets. We spoke to Avik Dey, CEO of Capital Power.
2026 is a year where Alberta pool prices are down, and we are taking advantage of that to do some key turnaround work at our key assets to position for a big upswing in that Alberta power market that we expect 27 going forward. So, which gives us the conviction for an ambitious growth plan that we laid out for our investors today.
You sure do. I mean, for one thing, you're looking for a 50% increase in your U.S. capacity by the end of the decade.
We are. The U.S. market is expecting a 20% increase in demand for electricity just between now and 2030. And we believe natural gas is best positioned to provide it because it's reliable, it's cheap, and it's fastest to market. And we've established ourselves as the clear leader in providing natural gas-fired power generation in North America. So it's an incredible opportunity for us to aggregate assets and do what we do best, which is optimize them, run them efficiently and safely, and convert it into more dollars and more power for consumers in each of the markets we're in.
I'm just looking at your stock. I mean, it hasn't done all that much over the past year. I know it's up over the past 5 years, but maybe if we could put up a one-year chart, it doesn't. It's down a bit, about 3%, despite all the excitement over power and AI data center needs. Why is that, Avi?
So there's a lot of promise in the market for establishing power purchase agreements with data centers. And there's a lot of conviction in the market for growing electricity demand. We've been very clear in our expectation that natural gas is going to fill that demand, and it's going to fill it for those that have existing assets. So we've seen significant improvement in our overall story, as well as cash flow, EBITDA outlook for growth, and converging on the multiples that our peers in the U.S. have. And for us in particular, I think the market's been looking for us to demonstrate that we can grow in the U.S., that we can in fact convert contracts into longer-term contracts, 10 years plus, and demonstrate we can deliver power purchase agreements to data centers, all of which we've done in this past year. And again, that's what gives us the conviction to double down on natural gas and put forward some aggressive growth plans to 2030.
But why hasn't the stock done more amid all this excitement, Avik, would you say?
I think overall, we're expecting to see more positive reaction from the market. We've got a great set of shareholders that value our dividend, our conviction around our dividend. And we've been working towards growth investors that see and put value in the growth potential of the story. And so for us, it's providing that narrative for both growth and value investors. And increasingly, we're seeing that conviction come from investors in Canada and outside, particularly in the U.S. institutional market.
And your yield right now about 4.5%. You're comfortable that you haven't covered?
We do. I mean, we have one of the most compelling stories in terms of dividend payout ratio, 30 to 45%. We're investment grade with a very compelling free cash flow yield. So from a leverage standpoint, from a free cash flow standpoint, from a dividend payout ratio perspective, we've got all the ingredients to deliver value through yield and compelling growth.
It must be an exciting time to be in your industry with this massive run-up in power demand.
Well, Andrew, what's really compelling about where we are in the sector is we have two prevailing thematics in the market, both that transcend every industry vertical in North America. The first one being the AI infrastructure boom that's changing the way we live and work everywhere around the world. And secondly, we have a growing reliability gap in our energy infrastructure. And so meeting reliability needs for consumers, meeting affordability needs for consumers means we have to invest significantly into new energy and power infrastructure. And we're looking to capitalize on that and provide that for consumers and customers both.
And we're tight for time, but you are saying that this agreement the Prime Minister, Mr. Carney, made with the Alberta Premier to allow laxer or a loosening of the emission rules on electric power, that opens the gates for you to build big gas-fired plants in Alberta.
We have a very important conversation in front of us as Canadians, which is how do we invest in infrastructure in this country and put capital into this country and create jobs for people in this country. And that comes through major infrastructure investment. the clean electricity regs themselves prevented investment into natural gas infrastructure. And with the repeal of that in Alberta, it opens us up to grow energy infrastructure in the province, serve data centers and critical infrastructure, and provide for economic growth in Alberta and Canada overall. And I'll note on natural gas, on the emissions point, we repowered a coal plant into natural gas and reduced emissions by half. One of the largest decarbonizing capital projects ever done in the country. So 3.5 MTPA per ton. So natural gas is a critical piece to the decarbonization story in this country and globally.
Avik Dey, CEO of Capital Power. Here's a look at U.S. futures as we count down to the opening bells. And it looks like we are going to get a softer open on Wall Street this morning, as we touched on Oracle disappointing investors with heavy spending in its latest quarter. Revenue seen as slow to emerge here, and we have seen that stock dropping more than 10% in trading. Let's have a look now at gold, because gold obviously trades, at least in part, on the US dollar. And when it's weak, you tend to get stronger gold prices. Gold holding in there and not quite back at its record highs yet. Goldman still sees a chance that gold gets to $4,900 an ounce by the end of 2026. Should private U.S. investors go on putting money into gold exchange-traded funds? Now these gold ETFs have become apparently the most common vehicle for gold exposure in the United States, but they're still only a tiny part of private financial portfolios. So the analysts are arguing that in those terms, gold positioning remains low. And let's have a look at oil. That seizure of a Venezuelan ship by the United States, raising concerns over supply from Venezuela. But here's an interesting note. International Energy Agency is trimming its estimates for a global oil surplus next year. Opening bells coming your way after the break. At the opening bells at the Nasdaq, it's Lumexa Imaging. At the NYC, Time is celebrating the 2025 Time Person of the Year, and it's actually a group, the so-called architects of AI, including Musk, Zuckerberg, and AMD CEO Lisa Su. At the TSX, it's Canadian Chamber of Commerce celebrating its 100th anniversary. It's time for the first 50. And let's have a look at the TSX. Let's see if it's pushing further into record territory today after closing at an all-time high yesterday. Oops, not quite. Down a little bit in early trading to kick us off for this Thursday. Let's have a look now at the U.S. markets. And you can see, the Dow hanging in, but the Nasdaq down almost 1%. Obviously, tech stocks, something of a cloud over them with the displeasure among investors over the latest results from Oracle. A couple of stocks that we're watching here. Dollarama increasing sales at a faster pace than analysts had expected. The stock edging up near to the record it got to in late November. And speaking of retail, let's have a look at Empire, the parent of Sobeys. And you can see down about 4%. Adjusted profit, according to Bloomberg's analysis, missing expectations, 69 cents. The estimate was 70 cents. And as we mentioned in the news headlines earlier, the company talking about higher staffing costs and investment in new stores. Let's check out some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. update us on Oracle, if you would, Jeff. Thanks very much.
Yeah, you bet. Oracle is having just a brutal day so far here. It has been the worst performing stock in the S&P 500 in the early trading session. And if these moves hold, it looks like it's going to lose about $89 billion in market capitalization today. What happened? The company put out a third quarter guidance outlook. And even though the company expects to grow its cloud sales revenue 37 to 41% in the third quarter, this just shows how high expectations were for these cloud-based and AI kind of linked companies. That is not good enough, apparently. 37% growth to 41% growth. Wall Street had expected 42.3% as kind of an average of Wall Street expectations, and the stock is just getting pummeled so far today. Looks like we're down about 16% right now. JP Morgan cut their price target to $230 a share for the stock from $270. The price target is under review at Morgan Stanley. So really, as I mentioned, 37% growth at the low end would be, I suppose, something that a lot of other companies would celebrate. But the expectations are just so high in this kind of AI-linked stock space right now that that's a disappointment somehow for the tech sector.
Disney is making a $1 billion equity investment in OpenAI.
Yeah, and the stock popped this morning as a result. It's going to be interesting to watch over the course of the session because these gains looked like they were a little bit short-lived when they happened. So this is a deal which will allow, so Disney not only is making a $1 billion equity investment in the ChatGPT owner, OpenAI, it also has an opportunity to make further equity investments if it wants to, and in return, OpenAI is going to be allowed to use some of Disney's characters, the Disney characters, the Star Wars characters, the Pixar characters to make small or short, I guess, AI-generated videos. Disney will also become a customer of OpenAI. So really interesting deal, worth watching the stock over the course of the day here.
And Eli Lilly doing well with an experimental weight loss shot. Some people losing dramatic amounts of weight.
That's right. This is kind of what they're calling their kind of next generation weight loss drug, and Wall Street is over the moon with what the results seem to show. This is a drug that is called, pardon me, I'm going to get it right, retatrutide, and according to results that were released this morning, it's a 23% decrease in body mass for some patients. 23% decrease, which is enormous. Already, the weight loss drugs have been kind of taking Wall Street by storm, and also, have kind of changed the game in certain cases for weight loss drugs. This is the next generation. BMO said that there was a very high bar for this company going into these trials, and it looks like it met that high bar with this drug. So definitely a stock to watch today and a stock to watch going forward. Eli Lilly is one of these companies. It is really flirting with getting close to a $1 trillion valuation, which we have not seen. We've seen a lot of tech companies get there, and we're watching to see Eli Lilly, which is close.
Jeff, thank you very much indeed. Jeff Morgan of Bloomberg. Up next, we're going to take a look at the prospects for the Canadian dollar after the Bank of Canada stood pat on interest rates yesterday. Bank of Canada holding steady in its interest rate decision, the last one of 2025. It stuck with the overnight rate at 2.25%. What could this mean for our currency? Usually when a central bank holds off from cutting rates, it supports a currency. We're joined by Steve Kolchak, VP of Options Dealing and Structured Products at Monex Canada. Thanks very much for joining us. Just remind us, what is Monex Canada? What do you guys do?
Absolutely. Yeah, Monex Canada is an international brokerage. We work generally with corporates and institutional companies that effectively are looking to manage their risk, deal with payments, and exchange currencies.
So what is your view on the Canadian dollar? It has had something of a rally against the US dollar lately.
Sure, yeah, the hold from the Bank of Canada yesterday certainly helps support the loonie. The one thing about the long term, though, right now is the fact that structurally, at least, we're looking for reasons why people will want to invest in Canada, right? So from a Canadian dollar strength perspective, I still think that it is a little bit limited from a big run to the upside against the US dollar especially. But tariffs are going to play a really, really big role in that moving forward.
Yeah, but do you think there's going to be a cloud over Canada because of the tariffs?
Because of the tariffs, the housing market is not helping as well. I mean, when you're looking at any sort of central bank movement, when it's going to react to a currency, when a currency is going to react to the central bank movement, you want to know that that currency also has a reason to be invested in, right? So structurally speaking, from a housing market perspective, from infrastructure as well, in the industrial front, I'm still waiting to see if we can find that reason for international investors to come into Canada before I can really call for a big Canadian dollar move to the upside.
But as you know, though, the federal government is going all out to try to stimulate private sector infrastructure investment. But you say we've yet to see how the cake turns out here.
We still need to see what happens. I think it's too soon to make a directional call on that.
Tell us how corporate customers have been managing their people who actually need to use foreign currencies. How have they been managing their currency exposure?
Sure, yeah, absolutely. It really all depends on how they're pricing, right? So effectively, if they're using a budgeted rate-based approach, effectively what we're seeing is, they're setting a budget rate for the year. They're looking at, okay, well, what am I going to set my pricing based off of that? For a lot of those companies, just because of the volatility that we've seen over the last 2 years, they are starting to increase those hedge ratios. And with a lack of implied...
Sorry, you went into a bit of jargon there. Sorry to interrupt
no
you.
Problem.
What do you mean increase hedge ratios? Sorry.
So they're starting to hedge a little bit more of what their expected cash flows are going to be for the year than what they normally would have done in the past. So for instance, let's say there's a company that is going to be doing $20 million in foreign exchange for the year, and it's going to be equally priced out over time. They're now hedging, 60 to 70% instead of the 30 to 50% that they would have been doing before, simply because it's been so volatile.
And obviously, if you're an exporter, you're earning foreign currency, a rise in the Canadian dollar hurts you.
Absolutely. Yeah, and a lot of these companies can't change their pricing. So what they're doing is, like I was saying, they're increasing those hedge ratios. We are seeing them move away from short vol products as well. Implied volatility hasn't really kept up with realized volatility. So shorting vol is not really seeing the returns that we would have seen, this time last year.
So what kind of hedging do they do? Just swaps?
They're doing a lot of swaps, they're doing a lot of forwards, and a lot of long vol products on the options front. So vanillas and some binaries to sort of offset any sort of potential margin calls.
When you talk, though, to clients, they just are uncertain, as you mentioned, yeah.
Absolutely, it's a coin flip.
Mm-hmm. Right. What about investment industry clients? What are they doing? Because they might have big portfolios of foreign stocks, for example.
Absolutely, yeah. And it really all depends on where their portfolios lie, right? So when we're looking at, equity portfolios and investment firms, they are starting to sort of do the same thing. They're keeping with the rolling forward approach, the swaps approach. They are starting to maybe play around with their hedge ratios, but that's really sort of as fancy as they'll get. On the emerging market front, though, they do need to sort of get a little bit fancier in that implied volatility is very, very high. However, carry is very high in these currencies as well.
So, the interest rates you need if you're borrowing, yeah.
Exactly. So the cost of carry is so high that if you were to just put on a forward or a rolling strategy, you're effectively locking in losses.
Can you remind us, we heard some drastic, well, I won't say predictions, but there was concern a couple of weeks ago after the Japanese finally let interest rates move up. Mm-hmm. People were saying, that global carry trade where people borrowed cheap in Japan, yada, yada, was going to erode. Has that come to pass?
Not in currency markets just yet. Obviously, we have seen a bit of a reaction in the yen, but I think it's still tough to see what's going to happen in the future on that front.
Because it has been for decades, it seems, it's been a cheap source of funding for people with an international perspective.
Absolutely. Yeah, so they might be going elsewhere in the longer term, medium to longer term.
I'm just looking at the Canadian dollar versus the euro. So we're looking at around 161. It'll cost you in Canadian dollars to buy a euro. So we have strengthened a bit. In mid-October, it would have cost you $1.64.
Absolutely, and a lot of our importers specifically that are purchasing euros in order to purchase inventory, they're seeing this as a buying opportunity, where this time last year, this would have been an extremely high rate, right? So I think a lot of people, when it comes to the euro, are starting to reconsider what a good rate actually looks like, specifically against the Canadian dollar.
Right. So, but I mean, we have weakened. So we're about a buck 62 now to buy a euro. But even at the end of 2024, it was less than a buck 49.
Yeah.
So we have weakened. I guess we've been dragged down by the US dollar this year.
Dragged down by the US dollar, absolutely. I mean, we sort of work in tandem with the US dollar, but at the same time, the ECB ended their cut cycle a lot earlier. So they have had the benefit of hindsight. But now when we look at the Canadian dollar, a lot of people right now are hoping that now that the Bank of Canada has sort of said, hey, let's pause everything, let's wait and see what happens, that potentially the Canadian dollar can sort of rebound against a lot of these other currencies that it has been underperforming against.
And just finally, crypto or blockchain, has that been coming into your business much? Or
it hasn't. We have seen a little bit on the payments front where people are using blockchain-based payment rails, but not necessarily into the Monex business yet. I know that stablecoin is really kind of that buzzword that's out there right now, but we haven't really seen it affect the industry just yet.
That's interesting. So the adoption is not head over heels. So people are being cautious, it sounds like.
Exactly. I think that there's still a lot of questions that need to be answered, specifically from a corporate front. I think there's a lot of people that are out there and they're still not sure about the technology itself.
Steve, thank you very much indeed.
Thanks for having me.
Steve Kulchak joining us there, VP of Options, Dealing and Structured Products at Monex Canada. Yesterday on Market Call, we were joined by Eric Nuttall, partner and senior portfolio manager at 9 Point Partners. He covered energy stocks. His top ideas were Whitecap Resources, Expand Energy, EXE in New York, and Peyto Exploration. Today on the show, it is Bruce Campbell of Stonecastle Investment Management. He's taking your questions on Canadian stocks. Coming up, Treaty 8 First Nations of Alberta are on Parliament Hill this morning to present their formal objection to the Canada-Alberta Memorandum of Understanding and Related Pipeline Initiative. That's after the break. Treaty 8 First Nations of Alberta are on Parliament Hill this morning. They are objecting formally to the Canada-Alberta Memorandum of Understanding and Related Pipeline Initiative. Let's get the latest from Jeremy Sharon of CTV News. Jeremy, give us an update if you would.
Yeah, Andy, look, we'll hear more this morning, as you've touched on, from Alberta's First Nations, Treaty 8 Alberta First Nations, which is interesting in the sense that we've talked a lot about Indigenous opposition to this potential pipeline to the BC North Coast, but mostly from BC First Nations. We've been talking a lot about the impact it would have on them and their opposition. Not so much about Alberta's First Nations and their opposition. So that is interesting in the sense that this could be another hurdle that the government of Alberta and the federal government will have to cross in potentially moving forward with this pipeline project. The First Nations will be here this morning holding a press conference at 10 a.m. And they are looking to put forward their opposition or their objection to the recently announced MOU and to talk about the ongoing lack of meaningful engagement and consultation with Treaty 8 First Nations. But I think the thing that is important to highlight here is that, we're talking about opposition in Alberta to a pipeline from First Nations, not in BC. The big hurdle that has been talked about so much has been in the province of BC. This could be yet another thing that both governments will have to face. And in terms of Alberta's Premier Danielle Smith, who widely has much support for the potential of a new pipeline moving out of her province towards the BC North Coast and gaining access to Asian markets, there is also opposition in her province from First Nations. So, it'll be interesting, and we'll learn more this morning from those groups. But another kind of important development, if you will, in the potential for a pipeline moving forward.
I know the Treaty 8 First Nations have raised concerns as well about Bill C-5, which would speed up approval for infrastructure projects.
Yeah, exactly. Their opposition is, and we'll hear more this morning about whether or not, in this case, it's opposition to the project itself or the potential of a pipeline, or more so the lack thereof consultation and collaboration so far. But I think that is a major element of C5 and their opposition to C5 is when it comes to concerns about proper consultation periods and proper engagement with First Nations that are involved, whether they will benefit from it or not, whether or not they widely support the projects. They would like to have a seat at the table. They want to be part of these, of planning in the early stages for these projects if they are going to run through their lands. And so I think widespread, that is the major piece here, is that they feel as though, the government has not followed through on its promise to engage early on and involve First Nations in these big projects. So it'll be interesting to hear more this morning from these Treaty 8 Alberta First Nations and their opposition to this MOU between Alberta and Ottawa.
Jeremy, thank you very much indeed.
Anytime.
Jeremy Sharon of CTV News. Up next, Dollarama increasing its sales forecast and it beat expectations in the latest quarter. We'll have more after the break. Dollarama raising its annual sales forecast and it beat expectations in its latest 3 months. We're joined by our own Lindsay Biscaya. Lindsay.
And Canadian demand in particular, Andy, is really what's driving these sales in this quarter, accounting for more than 90% of Dollarama's total sales in the third quarter, just the Canadian stores. So the company is saying it's seeing more people going through its stores more often and actually buying more stuff, which is obviously also maybe a sign of the times as people look for cheaper alternatives. And you can see now Dollarama up almost 5% throughout the year. So in the third quarter, net sales up 16%.
Or almost 50%. Over the past year.
Oh, yeah, sorry.
Right.
Oh, yeah. Net sales up 16%. It's just so many numbers. Quarterly sales up 22%. When it comes to Canada in particular, as I mentioned, driving those sales, comparable store sales increased by 6%. So currently there's more than 16,000 stores across Canada, and then Dollarama working to roll out stores under different names in Latin America and Australia as well. But it's interesting just seeing how many of those sales really accounting for in Canada.
And increasing their sales forecast.
Yes, increasing their sales forecast. They're now expecting to perform better than expected for the rest of the year and into 2026. So this is actually specific to Canada as well. And as I mentioned, there's still a rollout of chains happening elsewhere. But when it comes to Canada, comparable store sales target increased to a range of 4.2 to 4.7%. That's up from 3 to 4%. And gross margin expected to increase slightly as well. And capital expenditures are expected to be lower. So once again, a sign of the times here is we're seeing people, look for cheaper alternatives. Dollarama is saying they're seeing their sales go up. We saw that in the second quarter as well. And it seems as though they're expecting that for the rest of the year. And then also in the third quarter, Dollarama mentioned they're having their call very shortly, so we'll get more information. But they mentioned the Halloween period of this year. There was more days that shoppers could shop for Halloween, and so they saw that account for number of sales as well.
Yeah, they are. I mean, if you want plastic skulls for Halloween,
they're kind of everything, right? You can get Halloween stuff, cleaning supplies, party supplies, office supplies. I think you can get food there. So yeah, you can get whatever you're looking for.
One time I bought some Halloween stuff at Dollarama and put it in the front yard. And my wife said, no, you have to take it down. It's disturbing. It's not
disturbing.
Just Halloween funny.
Interesting.
It was disturbing, she thought, what I had done.
Okay, well, a good pitch for Dollarama for sure.
I don't want to say what I did. I don't think it was that bad, but she was disturbed.
Now I'm curious.
I'll tell you later.
Yeah.
Okay. Okay, let's check in on the equity markets. We'll have a look at Empire. Oh, there's the TSX to begin. Whoop, yes. Dollarama's a place to buy streamers and stuff. I don't think they sell sparkling wine yet, but if Premier Ford has his way, I guess we will soon be able to buy it there. Anyway, we're celebrating the TSX now above 31,500 for the first time, trading in a record territory. Let's have a look at Empire, the parent of Sobeys and Freshco and Farm Boy, and you can see that stock falling, profit missing expectations, and investors don't seem that thrilled by the latest numbers from Empire. Premium Brands is a big player in processed and packaged food, shrink-wrap sandwiches, but huge in processed meats, for example. It has a big acquisition in the works. It's going to acquire a company called Stampede Culinary Partners, which is involved in culinary solutions and a protein platform. I don't know what that really means, but I'm sure it involves meat, with a nationwide presence in the United States. And this is pretty big. The purchase price is $662 million US, 662. More than $500 million of that is cash, $500 million US, and they are issuing about 2.2 million common shares. So that's a massive acquisition by Premium Brands Holdings. Coming up, we are going to focus on that sell-off in Oracle. Welcome to the second hour of the Open. Let's check out the big stories we're bringing you from our newsroom. Canada has recorded its first trade surplus since the beginning of the year, driven by a rebound in exports. Data from StatsCan indicates that the nation posted a surplus of $153 million in September after a deficit of more than $6 billion in August. Total exports saw an increase, led by a spike in metal and mineral products. Meanwhile, Canada's trade surplus with the U.S. widened to $8.6 billion, marking the largest since February. Transcontinental logged lower profit and revenue in its fourth quarter, missing estimates. The Canadian packaging and printing company says the retail services and printing sector experienced challenges in the quarter, due partly to labour disruptions at Canada Post. Earlier this week, Transcontinental agreed to sell its packaging business for $2.2 billion. Packaging accounts for most of its revenue. Suncor Energy has unveiled its plans for next year, and it includes growth targets for production as well as an increase in share buybacks. The energy giant now expects total production of up to 870,000 barrels of oil a day. Now, that is growth of more than 100,000 barrels over its 2023 output, and it surpasses targets outlined last year. Suncor is also increasing its share buyback by 10%. TSX now slipping from that record high that it briefly hit earlier this morning. Let's have a look at the U.S. market because stocks opened weaker south of the border. And the big traders, we are seeing some selling in NVIDIA, down 3%, and Oracle now down about 14%. Tesla down, Broadcom down, Microsoft holding its own, but a lot of the big tech stocks weak this morning in U.S. trading. And let's have a look at oil. Oil has been mired now below $58, but it is interesting to hear that the IEA is actually trimming its estimate for an oil glut next year. And let's have a look at gold, because of course gold tends to do well when the U.S. Cuts interest rates, and the American Central Bank did that yesterday, bringing its main interest rate down to a range of 3.5 to 3.75%. But this is the first time in 6 years that three officials actually dissented against the decision. And let's have a look at the Canadian dollar. It's had a minor rally against the U.S. currency lately. Shares in Oracle down sharply today. The company's cloud sales disappointing investors, and a rise in AI spending has investors concerned that it's not translating as fast as they want into actual revenue. Our guest says the market seriously doubts Oracle's ability to become a major AI player. We're joined by David Sekera, U.S. Chief Market Strategist at Morningstar. David, thanks very much. If we look at Oracle stock, it had already tumbled from its highs and taking another pounding today.
Yeah, and I think when I look at Oracle, that and CoreWeave, I mean, these are really two of the prime examples that we've been pointing out about some of the buyer exhaustion that we're seeing in some of the AI stocks out there. Yeah, as you noted, I think the market really has some serious doubts about its ability to become a major AI player over time. And in fact, the stock is actually now well below where it was trading even before they made that major announcement a number of months ago that they're making such a huge transformation into their data center build out. So when I'm thinking about this stock going forward, I know management did reaffirm their guidance, so that's going to require really some pretty significant revenue acceleration in the second half of fiscal 2026. So in my mind, I think this is really going to be a show me story for at least several quarters. I think the stock is going to have to go through a bottoming out process. I think what management really needs to do here is have an investor day, provide a much more detailed roadmap as far as how they're planning on financing the build outs, provide a much greater detail for their free cash flow forecasts in order to help assuage a lot of the concerns in the debt markets, and really put out some better numbers as far as what the return on invested capital projections are going to be. And then I think it's going to take at least a couple of quarters of them just regularly executing on those plans, really to get market sentiment to come back on this name.
Adobe, apparently the market taking mixed signals from their numbers. They came out with a 2026 forecast that was seen as underwhelming, but their Q1 earnings beat expectations.
Well, and in fact, when I look at this name, according to our analysts, they've now beaten our own expectations here, for 6 quarters in a row. So this is one where I think, the market's really assuming that AI at the end of the day is going to end up eroding the value of their products. Our team thinks otherwise. When we're looking at annualized revenue and RPOs, both of those are still outgrowing revenue. I think that sets the company up for a good, 12 months, over the course of the next year. And when we think about, in this case, artificial intelligence, it's really going to be a tool that's going to end up helping them improve the economic value of their products and services over time. So this is another one where I think management really needs to do a much better job to really sway market opinion that their business, is not going to be overcome by AI. In fact, AI will actually be able to help them make more economically value-added products over time. Taking a look at our forecast, we're looking for 13.6, compound annual revenue growth over the next 5 years. Yet the stock is trading, well under 17 times our earnings estimate. So I think this is a good one. Do some added due diligence. Read through the stock analyst notes, but also spend some time, looking at the innovations that Adobe has displayed in their past couple of conferences. And this is one definitely in our mind to watch for 2026. 5-star rated stock. I think it's trading at about a 40% discount to our fair value.
You have some holiday stock picks for us. Starting up with Amazon. What attracts you here?
Well, of course, with Amazon, there's going to be a lot of Amazon boxes sitting on people's porch steps, coming into the holidays, thus far this year. And I think with Amazon, it's really much more than just their retail business. I think the market, significantly undervalues the advertising part of their business. Of course, they have AWS, huge total addressable market yet to come on that one. So a lot of growth still in the stock that we're looking for to, perform over the course of next year. Another one where I'm looking at, 5-year compound annual growth on the top line, over 10%, earnings growth, 13 to 14% over the next 5 years. And this is one that, rarely trades that much below our fair value, currently a 4-star rated stock.
You have another idea here, Mattel, the toy maker. What draws you to this name?
Well, this one's actually more of a swap recommendation than anything else. So last year for our holiday picks, we had recommended Hasbro. I believe that's up, almost 50%, since then. Mattel, very strong core brands, Barbie, Hot Wheels, Fisher Price. We've had some problems with tariffs. We think that disruption is behind them. We're looking for double-digit growth here in the fourth quarter. We think inventory positions have been cleaned up. They're much more in line with holiday expectations. So we're looking for their turnaround efforts, to pay off in 2026, looking for some operating margin expansion. So this one is, currently a 4-star rated stock, trades almost a 20% discount to fair value, looks attractive to us.
And then finally, you've got a small cap REIT focused on shopping malls. Is it Macerich? Is that how they pronounce it?
It is, and that's a 4-star rated stock at a 24% discount to fair value. Pretty healthy dividend yield at 3.9%. They focus on Class A shopping malls, the higher quality shopping malls. Overall, I think the death of the shopping mall in the United States is really just greatly exaggerated. The shopping malls have done a great job changing up the portfolios. They're becoming much more experiential. You're seeing them putting in things other than purely just retail to drive foot traffic. Yet consumers still want that in-store experience as well. So this is one that I think will do well over time, especially because the real estate sector, in our view, is probably the most undervalued sector in the U.S. today. Trades at about a 10% discount to fair value. It's going to have some good tailwinds in 2026, ongoing easing monetary policy. We expect long-term interest rates to come down and looking for a rebound in the U.S. economy in the second half of next year.
Thank you very much, David, as ever. David.
Oh, thank you.
David Szekeres, U.S. Chief Market Strategist at Morningstar. Up next, a new report highlights how each province has been performing in different housing categories. We are going to hear from Mike Moffat, the prof, who is concerned about young people missing out on economic benefits in Canada. We're going to be right back. A new report grades the performance of each province when it comes to providing housing. We're joined by Mike Moffat, founding director at the Missing Middle Initiative. Mike, thanks very much. Can you just remind us, what is the Missing Middle Initiative? What is it aiming to achieve in housing?
Yeah, so we're a think tank housed at the University of Ottawa that looks at housing issues and any issues relating to Canada's middle class.
Right. And I think part of your work, though, has been on young people and how housing in particular, they've missed out.
Yeah, absolutely. That we've seen over the last couple decades, things get harder for young middle-class Canadians. And most of that, not all of that, but most of that is revolving around housing. That, we're seeing home ownership rates fall, young people having to live with their parents longer, getting priced out of our big cities. So it's a top of mind concern for us at MMI.
And what is this middle housing that you think we need to build more of? It's triplexes and duplexes, for example?
Well, it's more of everything, but certainly we need more what we call family-sized housing. We've been pretty good over the last 15 to 20 years of building, one-bedroom condos and things like that. But where we're really short are kind of 3-bedroom homes, the kind of place where a couple might be comfortable raising a child or two.
So this report, what criteria did you use on, give us one or two, there are many, I know, but what were you trying to achieve with this report when you compared the provinces?
Well, we just wanted to look at how different provinces were doing. So we got 36 different indicators revolving around both policy, so the types of policies that they were implementing, and outcomes, what are they achieving? And interestingly, we found that provinces did best, not so much by implementing good policies, but by avoiding bad policies. So things like high development charges, high land transfer taxes, and so on. They seem to be negatively correlated with outcomes like young people being able to buy a home and affordability and so on.
Let's look at the provinces that you think have been doing a relatively good job, starting off with New Brunswick and PEI, the two Atlantic Canadian provinces. What in particular, why have they been achieving goals, do you think?
A lot of it is just they're getting out of their own way, that they're not implementing a lot of policies that are, again, harmful taxes. If you look at a place like the city of Toronto, they've got hundreds and hundreds of planners, hundreds and hundreds of policies, and everything's coded in red tape. Charlottetown, on the other hand, yes, it is smaller, but it just gets stuff done. There's fewer studies that need to be done and so on. And again, that was a big theme of the report, that, cities and provinces tend to be their own worst enemies when it comes to housing.
What, they just too much procedure, too cautious, for example?
Too much procedure, too cautious, absolutely. Taxes that are too high. That provinces that find ways to build infrastructure cheaper and kind of spread that cost fairly across society tend to have much better outcomes than places like Ontario, where we load all of our infrastructure costs onto residential mortgages, which is both an unfair but also a very expensive way of building infrastructure.
And that's, of course, because of these infamous development charges imposed by municipalities.
Yeah, absolutely.
Alberta doing quite a good job. Is that again because they tried to keep red tape to a minimum?
Yeah, absolutely. That Alberta does particularly well on creating new supply. So this isn't just a case that, provinces with slow population growth are doing well, that Alberta is growing faster than anyone, but still able to keep supply up because of that, avoiding red tape and keeping taxes relatively low.
Let's get to the underperformers, and we better jump to Ontario. You're giving the province with the biggest population a D. What is Ontario doing wrong? Because we know that, last I looked, the housing starts were falling in Ontario.
Yeah, absolutely. So Ontario has the highest development charges. We have among the highest land transfer taxes, which causes existing homeowners not to downsize on their home. We have the longest approvals process. So Ontario really gets into its own way when it comes to housing. And both Ontario and BC do a lot of what we call kind of irrelevant policies. So instead of focusing on taxes and reducing regulations, they're doing stuff like foreign buyers taxes and short-term rental regulations and things like this, which can sometimes be helpful, but they don't attack the core problem.
It's interesting. I mean, in Toronto, I guess other communities, if somebody wants to put up a duplex, they have a big hearing involving local residents. I wonder, do we really need to do that? I think the neighbours should have a say, but I don't see why people several doors down the street, they have to be listened to.
No, I don't either. That I think we should make straightforward rules and abide by them. And that's, that tends to be the approach in Atlantic Canada, outside of perhaps Halifax, where they set straightforward rules. And if you comply with them, you can build. And if you don't comply with them, you can't. Rather than making everything so subjective and such, needing all of these hearings and so on.
Well, I know I'm generalizing, but apparently at these meetings, you get a bunch of old, comfortable people who've paid for their houses years ago coming out and saying, oh, no, that would destroy the area.
Yeah, absolutely. I love attending. I mean, I'm close to 50, and sometimes I'll be the youngest person in the room by about 20 years. So that absolutely happens. And you can understand why that, if you are able to reduce competition in your neighborhood, if you are able to keep the number of homes relatively low, that's going to make your home more valuable. And, people as well want to keep their neighborhood unchanged. And I can understand that instinct, but it is blocking young people from ever able to own a home of their own.
Mike, thank you very much. Always enjoy following your work. Really appreciate it.
No, thank you for having me.
Mike Moffat, founding director at the Missing Middle Initiative. Coming up, the Bank of Canada standing pat on interest rates. And there is an expectation this could be an extended pause. We'll get more after the break. On the ETF report today, we're looking at some trends in the U.S. market. Let's pop up a 10-year chart for the S&P 500. Of course, it has been led higher by those tech stocks, although many of them have come off the boil lately. Our colleagues or our partners at Bloomberg Intelligence argue that there is a trend that's set for momentum in 2026 in which ETFs, active ETFs, will be seeing stronger adoption in 2026. Bloomberg argues that this is going to support renewed demand for selective stock picking. And of course, there are fears that if you just buy a traditional ETF, that was what ETFs were designed for originally, that you would just hold the whole market because usually traditionally active managers can't keep up with the index. But there are concerns that if you're holding just a plain vanilla S&P 500 ETF, you are getting overexposed to tech. As another interesting trend coming from Bloomberg, maybe we could put up a 5-year chart for BlackRock, because they're a huge player in these products, including the new breed of crypto ETFs. Now, Bloomberg Intelligence arguing that, yep, we're going to see a new tidal wave of ETFs involved in crypto, stable coins, blockchain over 2026. Bloomberg actually calls them exchange-traded products. These crypto-linked vehicles have more than $150 billion US already on US exchanges, and another, so that's more than 120 of them in total. Another 124 have been filed for launch. So one thing, though, that's interesting, there's going to be life and death here. That's life, but there's going to be a bunch of liquidations as well. So there will be more digital asset ETFs, partly because of the SEC producing rules favorable to it. However, there will be as well a whole bunch of liquidations coming, maybe in 2027. For example, some products have found muted success, and products based on newer crypto assets may struggle. But we're likely, but I like this, issuers probably will do what they're doing, launch several funds and see what sticks. That's what you do. You just put it out there. That's it, evolution. It comes up with a peacock's tail. Oh, it worked. Okay, we'll stick with that. Apparently in the vintage days of Japanese technology, they would invent something. It would be half finished, but they'd send it out and sell it in Tokyo and see how it works, and that we'd get feedback from the public. Okay, so the wonderful world of ETFs, and remember, tune in Tuesdays and Thursdays for that report. The Bank of Canada holding its key interest rate steady yesterday, and this could be, according to many in the financial markets, an extended pause. We spoke with Cash Pashutin, CEO of First Avenue Investment Counsel.
It was priced in, and really the view of the masses. The question is, how much emphasis are we placing on this, or is Bank of Canada placing on some of the data that they're seeing in terms of how they look forward? I do believe, Roger, we're playing a very dangerous game in terms of trying to be very cute with managing inflation and ignoring the fact that the consumer is in a really challenging spot here in Canada. And I guess we'll talk a little bit more about how this can all play out, but no real surprises. But I think a very critical time for Bank of Canada in terms of the good or the bad that they can do to the economy as we move forward.
What is your worry that this may do then?
Well, look, I think it doesn't take much investigating when you look around, but the Canadian consumer is strapped, and it's not just sort of one segment of society or economic or earning potential consumer. Really all the way up the chain, you're seeing that the cost of living and really the consumer's ability to spend, I should say, is quite challenged. So the idea of potentially raising rates to me is absolutely reckless. I think it is nuts for Canada to be considering raising rates, given how fragile the economy is. And I think it's premature to say that they're going to do that. As we know, there is a developing narrative that this might happen as we get into later 2026. But I think that's suicide for the Canadian economy.
excuse me, and after hearing the comments yesterday, does it sound like there had been talk that it might happen? Now it feels like it's backed off a little bit. Does it feel like that to you, that we might not see a rate hike?
Yeah. Look, we do feel better with some of the language yesterday, but I would have liked to see, and I know that it wasn't surprised that rates were held, but I think that the economy and the consumer can use a rate cut here without the risk of inflation peeking its head out again. But again, I don't work for Bank of Canada. I'm just really looking at what can we do to prosper and what can we do for the Canadian economy to grow. So our view is that holding rates was a bit premature, and I think we believe that a rate cut would have helped the consumer and just overall sentiment going into next year. You have a variety of household carrying charges, from mortgages to other variable loans, that could use the help. And I actually think by cutting a rate quarter point here, you would have in fact de-risked some of the exposure that the consumer has as we go into next year. But again, I don't work for Bank of Canada, but this is going to be a big thing as we go into 2026, because if Bank of Canada decides to take what they view as being cautious or conservative to not have inflation peek its head out again, I actually think it could work against us the other way, because the consumer is really month to month in many cases.
What kind of a factor is the dollar in all this?
Yeah, so look, I mean, the what history has shown us is that historically, when you cut interest rates, it puts downside pressure on your currency, so your currency gets weaker. But the point that we all know as it pertains to currency is that it's always a relative discussion. So yes, cutting rates reduces or weakens your currency, but it's always relative to what. So we always talk about the Canadian dollar versus the U.S. dollar. The U.S., as we know, has been much more vocal about rate cuts. As we get into 2026, we'll see what happens with the Fed chair, if there's a change there or not. If there is, which we believe there will be, the rate cut narrative we think is going to become stronger. So, Roger, we could likely, or there's a probability that we're going to see an environment in 2026 where the U.S. is cutting rates and Canada is holding rates. And if that plays out from that input perspective, the Canadian dollar should get stronger. Now, there's obviously other inputs that play into the U.S. dollar, Canadian dollar exchange rate relationship, but interest rates are a big one. And as it stands now, based on that relationship, the Canadian dollar looks like it will get stronger as we embark on 26.
And bringing Ottawa in, we saw stimulus spending and promises for government efficiency. Do you expect to see more of that to help this economy, or does Ottawa have the money or have the ability to do it?
Look, they absolutely have the ability to do it. And I think that we're seeing some early positive signs that there's an awareness and a propensity to do that. Historically, the challenge with government has sometimes been that they don't see the issues from a consumer or voter perspective. But I also think the fact that they're talking about it is certainly a positive first step. But and even rolling out programs, I think these are all positives. But really, it's going to come down to once something is talked about, once something is approved, then how quickly do those dollars actually make it into the system, and how quickly does that stimulus program, whether it's building more homes or infrastructure jobs or whatever it may be, how quickly does that start to work itself in the system? So 26 is going to be an important year in terms of seeing these government promises go from promises to actually the dollars working in the system. And absolutely, I think they have the ability to do it. And I believe that the current government is aware and wants to do it. And so we're all hoping for Canada's good that it goes from promises to actual action with dollars in the system. Okay. Government historically, we know, has been bureaucratic. Things have moved slowly. But if the Canadian government here can get from promise to action, I think there's a lot of upside for the Canadian economy.
Up next, Constellation Software has been a disappointment for investors so far this year. We'll hear from an analyst who has reduced the estimated value of the stock, but still thinks it's good value. Canada has recorded its first trade surplus since the beginning of the year, driven by a rebound in exports. Data from StatsCan indicates that the nation recorded a surplus of $153 million in September after a deficit of more than $6 billion in August. Total exports saw an increase led by a spike in metal and mineral products. Meanwhile, the trade surplus with the US widened to $8.6 billion. That was the largest since February. Shares in Walt Disney edging higher today. The company is investing $1 billion US in OpenAI. As part of the deal, Disney is licensing more than 200 of its characters to use on OpenAI's generative video and image platform. In return, it will use OpenAI's models to build new products, tools, and customer experiences, including on its streaming service, Disney+. Shares in Dollarama hitting a record high. The Canadian company posted a 22% spike in revenue in its latest quarter, beating expectations. The discounter also posted higher profit. Same-store sales exceeded estimates. The boost has led the company to increase its 2026 outlook for Canadian same-store sales. And there's a quick look at the markets. The TSX back in record territory, not closing, but trading above 31,600. US stocks down amid selling in some of the big tech names. As the year comes to an end, we've been looking at some of the biggest movers on the TSX, and one of the biggest losers has been Constellation Software, down about 25%. Our guest has brought down the fair value estimate on the stock, but thinks it's undervalued. Let's get more from Alex Meadow, equity analyst at Morningstar. Alex, thanks very much for joining us. We keep hearing, people are concerned about the impact of AI on Constellation's business. Do you think that's the main reason for the malaise in the stock?
Good morning, Andrew. Thank you so much for having me. I think there's really three things kind of driving the performance this year. I would say number one, of course, is Mark Leonard's unexpected retirement, the founder and president of Constellation. I think number two, as you mentioned, is the uncertainty surrounding AI and the impact it will have on the business. And number three is the lower capital deployments, as M&A activity hasn't met consensus expectations. And so those are kind of the three major factors impacting the share price performance.
And you have brought down your valuation estimate on the stock. Why is that?
Well, look, we had capital deployment closer to $2 billion this year. The biggest driver for the share price and growth going forward is the amount of revenue that can come from M&A activity. We do not expect that they will reach that target. We now have it closer to 1.2 to 1.3 billion, and so we think inorganic revenue growth going forward will be slightly slower than we previously expected.
And sorry, they've been slower to deploy capital, you mean?
Yes, yeah. So the number of companies they've acquired in terms of the size has been below our expectations.
Why is that? Just people getting greedy? They won't sell to them?
I think there are a few reasons. I don't think it's necessarily greed. Actually, I think although the markets have done well this year, software has not performed well, right? And business owners want to sell when they can get good valuations, and I think valuations have compressed. And I think number two is they're looking for companies in new verticals, new geographies, and it takes time to build out M&A teams in new areas. And so, obviously, I think it'll just take a little bit longer to achieve this.
Some numbers there. Let's put up the stock price again. You had your fair value estimate at just north of 5,230 Canadian, or 5,230. You brought it down to 4,170. So it still is trading below what you think investors should be paying.
Absolutely, and I think, look, the long-term value of the company certainly isn't being appreciated by the market presently. It's just we think it'll take longer for them to achieve some of the growth that we had originally expected.
the company, it is fascinating, isn't it? It's done some spin-offs. It's famous for operating on a very decentralized basis. The spin-offs of companies into new publicly traded entities, is that a good strategy?
Of course. I think it's actually a competitive advantage for them. It allows them to achieve a lower cost of capital when acquiring larger businesses. And it's very interesting and very unique. Not many others do this.
It kind of reminds me of Magna International, our Canadian auto parts giant, used to do that because it gave managers of those units incentives, well, stock options and stuff, although they pulled back from that. Is this business of specialized software services, is it changing?
I wouldn't say so. Look, I think back to your first question, AI is certainly impacting everyone's lives. It's going to impact software broadly, but we think that when the question comes back to who's in the best position to harness the power of AI. Is it the end customer, or is it the enterprise that's addressing the particular workflows, right? And we think, as of now, AI should actually benefit these companies, benefit vertical market software businesses, as they know the customer better than the customer in many cases knows themselves. And so we think they can use this to accelerate products and create more value for the customer. And so, of course, there's a lot of change going on in a lot of these companies. Software is going to continue to change, but we think Constellation and broadly vertical market software is actually poised to benefit.
And I'm just trying to think, if we put up a 10-year chart for Constellation CSU, as you know, for years it was just a reliable stock. We would frequently get guests on BNN Bloomberg saying, oh, it's a stock you can probably hold for many years. But finally, it's let people down.
Yeah, I mean, look, when it rains, it pours. This has been a tough year. As I mentioned, their founder and president, Mark Leonard, retired, which is a major, I mean, that's a major impact on the company. Like I said, everyone's wondering about AI and how this will impact the future of software and more broadly just business in general. And then, like I said, too, capital deployments have been a little lower than I think we originally expected, which is impacting near-term growth. And so, look, this year has been tough, but we really do expect Constellation to bounce back in the next coming years.
Thanks very much, Alex. Really appreciate it.
Thank you so much for having me.
Alex Meadow, equity analyst at Morningstar. Coming up, we are going to zero in on some stocks, at least two of them related to healthcare that pay significant dividends. We'll be right back. Time for Hot Picks. Our guest is focused on the healthcare sector. We're joined by Don Nesbitt, Senior Portfolio Manager at FM Investments. Thanks very much indeed for joining us. Start off with AbbVie. Can you tell us why this one catches your eye, please?
Sure, and thanks for having me here. Well, let me just kind of back you up just real quickly with why healthcare in general. And that's because you get a pretty good earnings growth at a reasonable valuation. So, obviously the hot story has been AI tech for the last couple of years. And rightly so, because it's got the growth. But the healthcare industry in the S&P 500 is expected to grow about 20% annual growth over the next 5 years. Compare that to the tech sector's 22.5%. But the healthcare sector's selling at a relative discount of about 20 times those forward earnings, and the S&P 500 is at 22 times, and the tech sector is at about 28 times. So when you look at the PEG ratio of this sector relative to the others, it's actually the most favorable. In other words, you're getting the best growth for the lowest price, and so that's why we like this sector right now. So going into one of the names you talked about, AbbVie, a large biopharmaceutical, fell out of favor over the last couple of years because they lost one of their blockbuster, the exclusivity on their blockbuster drug Humira. But the other drugs coming in through the pipeline are doing well. Right now, this stock is got about 11% compounded annual growth. It is trading at about only 16 times earnings. That's about a 30% discount to the industry as a whole. And as you mentioned, it's yielding 3%. So this is a great opportunity to get a what we call a dividend growing stock.
And they are working on obesity drugs. I guess you have to these days if you're a pharma company.
Yeah, everybody is, right? So, and that actually is a good segue maybe into our next stock, which is also a large pharmaceutical, Pfizer.
Okay.
Pfizer is suffering from the post-COVID hangover. They did very well with the vaccine during the COVID, but then those sales began drying up, and the market has priced it very cheap at about something like 8.5 times earnings. But because that stock is so cheap, you're getting a yield of almost 7% on that. And as you just mentioned, recently they made an acquisition to get into the weight loss drug area. And but I would look at that as an option. They've got a lot of other good products in the pipeline, solid earnings growth. They've overcome the the COVID hangover, so to speak, and represents a great growth good growth and you're getting paid to wait at almost 7%.
That's a big yield. I mean, would the company be inclined to? Well, I guess they'd be very loath to cut it, but you hear this argument: well, if you're not getting paid if you're not getting rewarded for a dividend, why would you pay such a high one?
Yeah, so this is an anomaly almost that you are actually have this potential growth that you're getting paid for. The cash flow is solid. The other thing that has happened over the last 4 quarters, out of all 3 stocks have beat their earnings estimates, which is one of the things we like to see. But Pfizer in particular has done a really good job because of the low expectations around this stock. So we think that this could continue. Again, I think the obesity play is more of an option, and the focus is on its regular drugs and pipeline.
And then finish off with Medtronic, if you would. What do they do, please, and why do you like the look of the stock?
Sure, Medtronic's in a little bit of a different industry, so medical devices, and while we might not have heard the name, we all are familiar with probably their flagship product, which is the pacemakers. So they're very involved in that area and the cardiovascular, but they're also working into other areas like surgeries and producing medical devices for that. They've got very strong growth again. They've got a strong R&D. They plow back almost 10% of their sales into R&D. And again, not as quite as high of a yield, a little bit under 3%, but and again, it's trading at a discount of about 30%, I think, to its peer group. And again, you're going to get growth and get paid to wait for it.
Don, thank you very much indeed for joining us.
Thank you, Andy, and have a great day.
You too. Don Nesbitt, Senior Portfolio Manager at FM Investments. Coming up, CMHC has just released its annual rental market report. We'll have more after this. Let's check out the markets before we get to that CMHC rental report. There is the TSX trading in record territory. And looking at the gold stocks doing well today, a lot of them maybe not hitting record highs, but certainly multi-year highs. Let's have a look at Equinox Gold, a 5-year chart for that one. I believe this is a record high, or certainly it's a multi-year high. True of all kinds of producers. Centerra Gold, CG, Equinox is EQX. I'm seeing also copper stocks doing well. First Quantum, which is FM. Okay, there we go. Equinox Gold, multi-year high for Equinox Gold. Okay, and we got First Quantum and Hudbay Minerals, both of those two. Copper players hitting their highest in at least a year. So miners in vogue. No wonder the TSX hitting record highs. CMHC is out with its annual rental market report. Here to break it down, Camille Caramali of CTV News. Camille, what did you see in this rental report? And thanks for joining us.
No problem, Andrew. Yeah, good morning. It just came out about 45 minutes ago. So just having a quick read over some of the housing trends across the country. Most of it seems to be good news for renters as we're seeing vacancy rates increase to highs in some places like Toronto that they haven't seen during the pandemic. And in some places like Vancouver, where vacancy rates are seeing highs that they haven't seen since 1988, nearly 40 years ago now. So it looks like if for renters, at least, the trend is that there is more supply for them, and that means more choice and better rates as well. The slight downside is that despite that, the average rent for a two-bedroom unit rose more than 5% in 2025. So let's go back to where we're seeing and why we're seeing the higher vacancy rate in rental units across the country. The purpose-built rental vacancy rate across the country for 2025 rose to 3.1%. That is up from 2.2% in 2024, Andrew. And the reason being, we've reported on this a number of times, so have you. Years of strong rental construction supported by government programs means an increase in supply, while immigration policies have resulted in a decrease of demand. So we've seen, those policies that limit fewer international students, and then there's also the issue of rising youth unemployment. That's reduced the number of renters out there. But we are also seeing, as I mentioned, the rent for two bedrooms increasing to an average of over 5%. Now, it increased more than 5% last year, so it depends on if you want to look at this as glass half full, glass half empty, because it still has increased 5%, but that is less than what we saw last year. Why? There is still an increasing pressure on housing costs, with most of the two-bedroom rental increases coming from tenant turnover. So much of that increase having to do with a vacated unit being repriced at higher levels. So just giving you a snapshot of what we're seeing in the report so far. Bottom line, once again, vacancy rates continue to increase across the country in major metropolitan areas, with also a slight bump in the rental rate of a two-bedroom unit.
Real estate brokers tend to like higher home prices. It inflates their commissions. Royal LePage is forecasting an uptake in home prices in the new year.
Yeah, what they're saying is that they are forecasting the aggregate price of a home in Canada will increase 1% year over year in the fourth quarter of 2026. So it's going to increase a modest 1% year over year to just over 820,000 in the fourth quarter of next year. A single-family detached price for that is forecast to increase 2% year over year in the fourth quarter of next year. So, yeah, as you mentioned, increasing modestly in the next year. With condominiums also, speaking of rental units and housing projects, they're projected actually to decline 2.5% over the same period. So, once again, increases in the aggregate price of a home and single-family detached prices, Andrew, but a dip 2.5% in condominium prices is projected by Royal LePage.
Camille, thank you very much indeed for joining us.
Anytime. A lot of numbers thrown at you, I know.
We love it. We love it that way. Camille Caramali of CTV News. Thanks very much for watching. The Open Morning Markets is up next.